That's a nice little addition to Zoom. All right. So, guys, it's Tuesday, May 25th, and let's do our quick intro for 1 minute. Similar to all of our videos, our forum is private, our videos are public. Anything you may say on this video is widely disseminated, so please be advised about that. We are past 8,000 members now. Yeah, there we go. Thank you all to everyone who continues to make the forum awesome. There's no other administrative stuff, so let me just kind of leap right into corporations and real estate and how this all works. So let's go. So let's deal with the discussion that takes place every day, and you guys are very familiar with it as realtors. Mrs. Realtor, I want to take this property in the name of my corporation. And then you ask, oh, why is that? And then the client says, tax reasons. And you say, really? What tax reasons are those? And then the client says something that really doesn't make a lot of sense, but they know that they're backed into the corner and don't really understand what they're talking about, but don't want to admit it. So they say something along the lines of, because of taxes paid on sale. And then you say, but what are you talking about? And then they say, oh, the taxes I need to pay. And then you kind of start thanking the Lord that marijuana is now legal in Canada, because you're going to go smoke some of that immediately. You may also be thinking, I don't get paid enough for this, though as your realtors and you're paid on the basis of real estate values, and real estate values have been doing pretty fine these past couple of years. Maybe you don't say that. I don't know. But you maintain your professional composure, and instead you say, have you spoken to your accountant about this? Because while I'm not qualified to tell you what to do, I can tell you how a holding company for real estate works. And I'm not really sure that the benefits that you're thinking of may exist. And then they say to you, oh, talk to me, you crazy real estate guru, you. So let's deal with it. Let's talk about corporations. Because as we're aware, corporations are people, not actual people. No one dates a corporation. No one wants to have dinner with a corporation, but they are legal people, which means that they function as actual entities capable of suing people, capable of holding property, capable of doing any number of things that an individual can do. And it's pretty easy to set one up. I actually just set one up this morning. I finally incorporated legal review. So I just did it literally 5 minutes before I started this. And the setup costs are between, $1,500 and $2,000. The actual incorporation costs $750, and then there's some extra filings you may choose to do or whatever it is. And your annual filing fees do cost you about $1,200 when you go to an accountant. And have to incorporate. You have to file that every single year, just like a person. And you have ongoing compliance issues and everything else. But these are really minimal sort of costs. If you have a business that's deriving any sort of money, these aren't barriers to entry. These are just the costs really of doing business. Other than, when you're speaking to your friends and telling them you incorporated and they say, oh, I have a business idea, I want to incorporate, how did you do it? And have to spend countless hours kind of recounting that. There aren't really many obstacles to actually going ahead and incorporating. In fact, there are 3 primary entities that incorporate, and you can do it online, Encore, ESG, or Cyberbond, and you can just kind of go on and, pay your money. It's pretty simple. It's a breadcrumb process, and, anyone can incorporate basically. So why do people choose to do it? Okay, it's a legal entity, that's true. But practically, we're going to turn our attention today to what actually happens from the perspective of people who are investing in real estate, because that's what you guys care about. And the answer, of course, is that people do this because they perceive that there's a benefit. And the first benefit that they perceive is liability protection, right? If a corporation owns something, then, and it's not Mark Morris, but it's Mark Corp that owns something, well, then it's only Mark Corp that can be sued. So in the event that someone comes around and, trips and falls at the property that I own, they're no longer able to sue me personally and my assets are safe. But that doesn't really hold much water for corporations. And quite frankly, you should understand why. The simple fact is, all properties, particularly any property with a mortgage, requires insurance. And if you have insurance, then you're protecting against that downside liability risk. If someone has a slip and fall, they're suing they're suing you, it's true, but the insurance is going to come and protect you. I mean, there isn't too many things that you as a property owner engage in which is overtly negligent or anything else. Now, don't get me wrong, there are. I'm not suggesting to you that, there isn't an extra level of protection that is granted by a corporation. But generally, most of the things that people are concerned about when they hold property are covered by a standard insurance policy. And thus, the liability protection that you get when you're, say, starting out a business and you're signing a whole bunch of contracts or anything else, none of that really takes place within the corporation. And to the extent that you think that putting a corporation may shield you from the mortgage company, I have news for you, and everyone on this channel can certainly vouch. The mortgage company, if your corporation doesn't have assets, you're signing personally anyways. So that's not going to get around. So it's not really liability protection that causes people to want to use a corporation. And, not many people will actually say to you, oh, I want to buy this in the name of a corporation because I'm worried about liability. Because again, the answer is insurance. No, most people come to you and say, I want to do this because of taxes. I want to incorporate, they don't call it a holdco, but it's a holdco, a holding company that's going to hold this asset for me. And why? Well, because it's going to lower my taxes. And while in concept that's true, it's more often than not really a fiction. And the moment that someone starts understanding how the math works, the moment they can actually see through that and perhaps benefit from not going through the whole experience of incorporating and going through all the rigmarole for no benefit. So in order to understand how it works and why there's very little benefit for some property owners, in fact, most property owners, people who just are buying their first income property or something else, let's examine how it works. So how do taxes work generally? I know it's so odd to me that it doesn't matter if you're a lawyer, it doesn't matter if you're a realtor or a mortgage broker. No one really sits down and explains how taxes work to people. And it's a real shame because so much of our decision-making process is predicated upon tax rates. I mean, that's what it is. So let's just go through it quickly. So if someone, say, earns $250,000, then they pay a graduated rate of income. So I have here the 2020 taxable income charts. It's not that much different from the 2021, slightly different, but it's not much. So we'll keep on using it. And what it says is, okay, if you, say, are at a business and you're earning $250,000 a year as an employee of a company, on the first $44,740, you are going to have to pay 20% of that, 20.05% of that to the government. On the next $44,740, straight through $48,535, you have to pay 24.15%. Now, to be clear, this does not mean that the moment you earn $44,741, you are paying a rate of 24.15%. That would be ludicrous because that would be discouraging people from earning higher income. No, what it means is that on the first $44,740, everyone, whether you're a billionaire or you've only earned $20,000, has to pay a rate of 20.05%. Whereas if you earn more than $44,740, you then pay this rate. And above $48,535, you earn this rate, and so on and so forth, all the way up to $220,000, at which point you pay tax at a rate of 53.53%. By the way, taxes are an incredibly, incredibly political thing. It's probably the most political thing that a government does, because it really does speak to income distribution widely in our country. So as an example, I recall, because I'm now getting up there in my years as I approach my half-century Oh goodness, that's not healthy. Anyways, there was a time when I was working, when Dalton McGuinty was premier, when the tax rate was 42% above $220,000. That is to say, every dollar you earned above 200,000, I think it was 200,000 about that time. Every dollar you earned above $200,000, you paid 43%. Whereas now, every dollar you earn above 220, you're paying 54%. So what happened? Well, if you just look at that one figure, you say, aha, the government raised our taxes. And I'm not saying that the government didn't raise your taxes, by the way, but it's really important that you look at the remainder of the chart. Because what happened during the previous Liberal government provincially was that they raised these rates tremendously and then raised this rate. So what I mean by that is they allowed for a lot lesser tax to take place in this bracket, in this bracket, in this bracket, in this bracket, in this bracket. In other words, they ensured that there was a push down of the tax brackets such that people who earn less money paid less tax. And then they creamed those people who earned more money, above 220. Suddenly we went up 10%. Now, again, this isn't a polemic. This isn't a political diatribe. I'm just trying to explain to you that these things greatly matter. These things are these things have huge ramifications, and governments twiddle with them all the time. So that's how income tax works without a corporation. And it's really important you understand that, because if we're to discuss how income tax works within a corporation, you have to kind of understand how it works without. So let's turn our attention to calculating tax without a corporation, now that we understand how a graduated system works. So in the normal course, if I were just earning income, I take my gross income, $650,000, in your case, it could be commission, it could be whatever, $650,000, that's my total income. I mean, yeah, there's exceptions, but we're just keeping this conceptual. Then I calculate my net income. So what I do is I take my $650,000 and I minus my expenses. So what were my expenses in making my commission? Well, I had marketing material. I had to buy my drone so that I could fly around my listings, and also so I could play with it during the weekend, which I did this weekend. And by the way, DJI Zoom Mavic Pro is amazing, amazing. Anyone want to talk drones after? I'm completely down, but let's keep on going. So we have $650,000. We're subtracting $230,000 in expenses. These are just fictitious figures I'm making off my top of my head. And therefore, we get a before income tax amount of $420,000. And then we are able to take that $420,000 and plug it into this chart. Now, those of you who are astute with this chart will note that up to $220,000, there is always going to be a set amount. So that is to say, everyone who's earned over $220,000 will affect, oops, sorry about that. My apologies, I got a bit carried away there. This is what happens when you talk tax. So on the first $220,000, everyone pays $81,131.13. By which I mean, if you make over 220, the first 20% of 44,740 plus 24.15% of the difference between here, plus 29.65 of the difference here, plus 31.48 of the difference here, so on and so forth, equals a total amount payable of $81,131.13. And any amount over 220 is then calculated simply by taking the difference, so 200,000 in this case, because we've already calculated the first $220,000 worth of tax. We're calculating on the basis of 420. That's a difference of 200, and you multiply it by the top tax rate of 53.353%, and that's 107,000. And so for someone who is earning $420,000, right? They've taken their net income of 650, they've subtracted their expense of 230, they are then paying tax on their $420,000. The total tax payable on that 420 is $189,191.13 for as, oh, no, sorry about that. This line's not supposed to be there. Ignore that line, That's a typo. Sorry, I did this 1 hour before I actually just incorporated my own company. I was doing this and I put this into the wrong slide. I'm sorry about that. Please ignore that line. So just the total tax due and owing is 189,191.13. So great. We now understand how to pay tax without using a corporation. What happens if we use a corporation? Well, keeping money in a corporation is hugely advantageous. And let's see why. So the corporate tax rate for a general corporation in Ontario, as of 2020, by the way, it's slightly different, is 26.5%. Now you'll remember that the top tax bracket here is 53.53%. Aha, big difference, 26.5 and 53 point whatever. And what that means is that if I take in $420,000, so let's say I earn through a corporation $650,000, take off my expenses, I now own $420,000 worth of income that I now need to pay tax on. Well, I'm only paying tax at a rate of 0.265, meaning that the total amount of taxes that I'm paying on my $420,000 is $111,300 in taxes. Okay, this is the aim that people are trying to achieve when they turn to you and say, I'd like to hold a corporation. I'd like to hold my property in the name of a corporation. I'm going to be taking in all this money. I don't want to pay tax. I'd like to pay it at a lower rate and keep the money within the corporation. Smart, makes sense. So if you think about it, by using a corporation, the holdco has now paid $69,000, $69,891 in taxes, which is, what is this? How did we get that? Just a second. Oh, sorry, less, right. So if they had owned it personally, be 181,000 that they paid. They only paid 111,000, and therefore they've saved $70,000 in taxes by using a corporation under this structure. And this corporation now has $308,700 to play with. Now, let's be clear. A corporation is distinct from the person who owns it. And so let's say that the corporation was only owned by one individual. If the person wants to go ahead and pay their mortgage, or if they want to go ahead and buy food or use that money in any way, they have to take the money out of a corporation. And they do so through something called the dividend, through dividends, or through salary. We can talk about that, but let's say that they do it as a shareholder through dividends. And the way it's actually structured, I'm not going to go into it. It's beyond right now our course. But the way it works is that the tax, when you take it out of the corporation, roughly equals what it is you would have paid in your person had there been no corporation. So there is a tax when you take money out of the corporation and bring it to your person, which when combined with the corporate tax equals roughly the same amount of money that you would have paid had you not used a corporation in the first place. In other words, there's no advantage to earning money in a corporation if all you're going to do is take the money out of the corporation immediately. Because while you will be paying a lower tax rate by virtue of the 26.5%, you will also be paying an additional dividend gross up tax credit. Sorry, it's called the dividend gross up tax credit. You will then be paying an additional dividend tax, and that dividend tax plus the corporate rate of tax equals roughly the individual rate of tax. No advantage to using a corporation if you're just going to take the money out. But if you're going to keep the money in the corporation, huge advantage, because like an RRSP, I will be able to grow more money and use that money to grow and invest in other things before I take it out. And in doing that, I will have more money to play with, more money to invest before I take it out, such that when I take it out, I'm taking it out from a larger pool. Does that make sense? Sorry, there's someone who's asking, is someone asking a question or is someone talking? So guys, who has any questions about that? Anyone? No, we're good? Okay. So what this means is that a corporation has real use. There is good reason why your clients believe that they should be using a corporation to do this, because they understand in a conceptual sense that if I am earning money and the money can stay in a corporation, there is a lower rate of tax. Okay? Now, there's actually even more advantages to using a corporation, like income splitting. Just another reason that people might want to use a corporation, right? So let's say spouse one has gross income of $650,000 and expenses of $230,000, similar to before. And spouse two has income of $32,000 and expenses of $2,000. So the combined income of both spouse one and spouse two, if earned outside of a corporation, is less than if that income is earned within a corporation that can allocate salaries to individuals based on their tax brackets. So say that these are a married couple, right? And realistically, spouse two is at home with the kids, doesn't contribute that much, contributes a little, $32,000 worth of value to the company, whereas spouse one is really the reason this corporation takes hold. Well, come over the course of the year, they can go ahead and take this corporation, and instead of paying $650,000 to spouse one and $32,000 to spouse two, they can make it such that the incomes of both spouse one and spouse two are roughly equal because they control the corporation. And in doing that, what are they doing? Well, they're ensuring in the first instance, where they aren't using a corporation, spouse one is taking a huge tax hit at the 53.53% rate, because of course spouse two is only earning $30,000. But if they properly split it, because the corporation is allocating it both to spouse one and spouse two, well, then in this instance, you can see that the $220,000 level, the 53.53% tax, is only being paid on $2,676. And as a result, the taxes are significantly lowered. And I've done out the math for you, so you don't need to figure it out. In this instance, they would have to pay tax of $195,146, whereas in this instance, they will be paying tax of $169,614. So it's a difference of about $35,000 or $25,000. So it's significant. This is a significant reason to use a corporation. Again, when someone turns to you and says, guys, I want to buy this, I want to put this corporation in, I want to put the property into a corporation, I get it. I understand why you think you want to do it. But there is very little point. And the reason that there is very little point, and this is what's missing from everyone's analysis, so listen carefully. The reason there's very little point is because for most investors in the GTA, the math of a condo ownership, particularly in the first few years, is break even at best. It does not produce the net income which makes these corporations advantageous in the first place. Let's take an example of a holdco. And I use the most typical property I could think of in Toronto, okay? So we have rents. So we're buying a unit for $650,000. The rents are $3,250. Everyone will agree. You guys are all realtors. You can agree that this is a very typical scenario. Your taxes, $3,500 a year, very normal. Condo fees, $500 a month, 90% LTV. By the way, all investors want to maximize their LTV. So let's just say 90% LTV. Interest rate, let's make it an aggressive interest rate of 1.89, 25-year AM because it's an investment property, and that's kind of what's being insisted on. So I didn't push the boundaries at all here. This is very cookie cutter, vanilla plain investment. So what's the cost? The cost is $2,522.08, which is the mortgage of this, plus $291.66 in taxes, plus $500 in condo fees. So our cost per month is $3,313.74. And our total income is $3,250, which means that we're losing $63.74 per month. Let's reverse it. Let's make it so that, okay, you're slightly cash flow positive. Let's say that you're really cash flow. Let's say you're cash flow positive by $100 per month. You're now making $1,200 a year, which after expenses is going to come to pretty much zero because you're going to find a bunch of expenses or you're going to have depreciation. And as a result, you're not going to have money in the corporation in the first place. The whole structure only works if you are shedding off money into the corporation. But given what property values are in the GTA, and given how these costs work, there isn't a significant amount of money that is coming into the corporation in the first place from these rental properties. If there is, great, then we should be talking a corporation. But almost every one of you that goes ahead and purchases in today's real estate market with today's prices are producing something that's break even, or perhaps you're convincing someone to take it at a loss because the principal payments are going to make it break even, although the cash flow negative, make it cash flow negative. Who knows? I'm seeing all sorts of things. But rarely do I see a purchase that just bleeds cash into a corporation such that a structure should be put in place. And that is the reason that incorporation often doesn't make sense. There is no tax to save by incorporation because there's only minimal or regularly no net income on which to be taxed in the first place. Now, we should not be giving this advice. I'm talking to you as realtors. I'm talking to me as a lawyer. This is not advice for our clients. That is something which you have to cede to an authority. And I'm not an authority on that, neither are you. The authority is your accountant. And the way I deal with it when someone says they want to use a holdco is this. Look, I am very happy to talk you through, the same way I've just talked you guys through, why this might not be advantageous. But it is not up to me to decide. You must speak to your accountant to determine if it is advantageous. The point of talking to you guys is to make you aware of the fact that it probably isn't advantageous in the first place. And so let's not get ourselves in a huff about getting it into a corporation and everything else if fundamentally it's not going to properly serve the clients. You need to be able to identify that it doesn't properly serve them and give them over to an accountant who can advise them as to their particular tax situation. I'm going to pause for a minute. Does that all make sense what I said?
Mark, I may have missed it. I understand the first half about the sunk cost, and it doesn't make sense. But is there a phase in that ownership where it makes sense then to start transferring over?
It does. If you have a lot of your mortgage paid off, let's say you've gone let's say 10 years, and as a result, your mortgage has been paid off significantly, you're refinancing, and suddenly you find that it's profitable. Sure. But what I have not mentioned in this particular slide deck, but I'm going to mention to you now by way of this comment, is that you can always, as a personal owner of property, roll property into, or roll assets into a corporation tax-free. You cannot do the opposite. You can't roll it out. You can't spin it out is what it's called. You can roll it in tax-free through a rollover, Section 85(1) rollover, or 86, depending on what you're doing. But you could do a rollover in. So when it becomes profitable in 10, 15 years, assuming you're still holding on to the property, if your accountant says, wow, you're taking in a whole lot of cash, at that point, you can make the decision to actually incorporate and put this in, and there'll be no tax consequences. Does that make sense?
Absolutely. Thank you.
Okay. By the way, someone said that it's very choppy, cutting and cutting out. Is that me? Am I choppy? Have you guys been able to hear me? Okay, I'm going to assume you've been able to hear me. Tell me if you have, yeah.
So I have a question. So that rollover, but don't you have to pay a land transfer tax if you're transferring a rental into the corporation? Like transferring ownership?
Yes, you'd have, with some exceptions. I don't want to actually go into this too much. With some exceptions, but remember that that land transfer tax is payable on the greater of the consideration value of the mortgage then on title. It wouldn't be as significant as you may think, and there's one or two exemptions, but regardless, let's not touch that right now. I've actually approached that in a if you want to take a look at a taxation session that I did, I actually approached this very session and very question before. I want to keep things a bit focused here, if you don't mind. I'm happy to answer that after though. Okay, let's move on. So we are understanding that. And while we're on the bad stuff of corporations, and you can ignore this if this doesn't make any sense to you, and I'm not, again, I don't want to really make this too heavily in tax. Passive real estate companies, meaning if you have less than 5 full-time employees, like you pay CPP, and everything else, not like, oh yeah, I have a contractor here. If you have less than 5 full-time employees and your only job is to hold real estate, then you're a passive company. And as a passive company, you don't get the lowered, you don't get the low tax provisions. There's something for low tax provisions for active business. And you don't get the lifetime capital gains exemption when you sell your shares. Again, you don't need to know what this is or anything else. It's just if you know corporations and you know the advantages that bestow to active corporations, none of that exists for holdcos. I'm just bringing that up. So, okay. So look, this doesn't mean that no one is going to say, hey, I want to sign in a corporation. Some people are going to still say, okay, I hear you, Mark. Great, fantastic. But I happen to have a corporation that is going to net me money. Or alternatively, thank you very much. Go screw yourself. My accountant is saying to do this, and you always listen to the accountant because they're the ones who are responsible. So how does a corporation actually work? Well, it's interesting because, again, no one really explains this to anyone at any point in their career. You're just kind of expected to know this. And how, I don't know, but there it is. So a corporation works by virtue of the 3 people who own things. Put aside your uncle's corporation and your personal corporation, which where everyone is the same and there's no rules or anything else. Let's use Microsoft or Disney. Everyone's had like a Disney share. You used to get a Disney share as a kid or something, right? You were a shareholder of the company. You were an owner. Everything that the corporation did was for your benefit. But you had no control. You couldn't tell them, hey, I really don't want Mulan to be done in stopgap motion or God knows what. You have no control over the company at all. All you get is the benefit of ownership. That is to say, the financial benefit of ownership. You don't get any of the prestige. They don't invite you on Disney holiday cruises. You don't get invited to the holiday parties, and you don't get to make decisions. Who does? Well, the shareholders appoint the directors. And the directors are the people who oversee the company. They are the ones who make sure that the overall direction of the company is headed in the right way. They are the ones who appoint who deal with the substantive litigation. They're the ones who appoint the major slate of employees who will govern the company. So in Disney's case, the director is the person who will say, okay, they send around and say, who should be our CEO? Why? Because the CEO is the chief officer, the person who's in charge of the day-to-day, and the CEO will then hire out all the people who you know are part of the Disney Corporation. You know, HR and vice president so-and-so and the person who owns Marvel and God knows what. All of those are officers of the company, but the directors are the people who appoint the actual senior officers and make sure that the overall company is running smoothly. The directors are also directly accountable to the shareholders. They decide whether or not the money that is within the corporation can be divvied up to the shareholders or whether it should be used to further the business and grow it. They are the ones who are in charge of the substantive decisions, not the day-to-day of the corporation. Now, that's all well and good. If Walt Disney hires you to buy some land, you will immediately defer, please, to a lawyer who will do their work and everything else. That's usually not what happens. Usually what happens is someone says, oh yeah, I have a personal company. I want to sign this property for this property. So who can sign on behalf of a corporation? Well, anyone can sign on behalf of a corporation if they're authorized to. So firstly, obviously, if you have a unanimous shareholders agreement or a unanimous shareholder, if you're the only shareholder of the corporation, you can sign as a shareholder, right? Because ultimately, it's all for your benefit. And if you just pass a unanimous shareholders resolution, that supersedes everything. So if you're the only shareholder, boom, you can sign. Similarly, if you're a director of the corporation, Directors are authorized to sign. Directors pass bylaws within their minute books that say, here's who can sign for these particular matters. That's internally what happens. And if a corporation gets big enough, the directors also authorize the officers to sign, which is why at Disney Corporation, you don't need to go to Michael Eisner or whoever the director is and basically say, hey guys, can I buy a photocopier? There's someone at the officer level who can ultimately approve those purchases. All done through corporate bylaws that say this is the follows authorizations that are allowed to take place and how they all transpire and who is authorized. Great, but you're a realtor. You don't know any of this. How do you determine who can sign? Well, we'll deal with that in 1 second. In the meantime, let me backtrack and just talk about what happens after you determine who can sign. You basically sign like this. It says Legal Closing Incorporated, that's the name of the company, per Mark Morris. I would sign on the Mark Morris line. And then I would write whose signature it is, Mark Morris, and I would write comma ASO. ASO stands for Authorized Signing Officer. And then underneath it says, I have authority to bind the corporation. It is this line, ASO and I have authority to bind the corporation, that permits you to accept signatures from randos, from just random people, people who say, hey, I own this corporation. Why? Because they're holding themselves out as having that signing authority. There's something called the indoor management rule in corporate law, which says you don't need to actually go and investigate the books if someone is holding themselves out as having the authority to go ahead and sign. Now, don't get me wrong. That's not to say a lawyer will accept this. I'm talking about this from a perspective of people in business and from realtors. Now, you do have an obligation to take reasonable precautions and make your investigations. So how do I know if someone's authorized to sign the docs? You don't, you're not expected to review corporate books. That's the job of the lawyers. What's expected of me? Documented evidence, emails work great, that you had reasonable grounds to believe that an individual could sign for the corporation. Hey, Jesse, I know you want to put this in a corporation. Are you the only shareholder? Yes? Okay. Please go ahead and sign. Hey, Jesse, I know that you're part of a larger corporation. Do you have authority to sign? Yes? Okay. You're sure? You've checked it? Okay. Here we go. And then Jesse is going to sign it with the words ASO and I have authority to bind the corporation. And if Jesse is lying, Jesse is liable. Jesse will be liable. So if Jesse signs something for, say, the sale of an agreement of purchase and sale, but the corporation had something in its minute books that said, no, there needs to be 2 signatories, and only Jesse was only one of them, then yes, the corporation won't need to sell the land, but you won't be sued, Jesse will. Jesse will be sued for saying, I had authority to sign on this behalf. And the vendor, the purchaser of the land, will sue Jesse back to the Stone Age for not having had the authority in the first place. Your job was to show that you had reasonable grounds to believe that Jesse had authority. And by sending out your emails, you are fulfilling that job. So guys, it's 10:41. There's a lot that I could have talked about. There's a lot more tax I could have gone into. There's a lot more detail that I think I could have approached. But I kind of felt that really what was necessary was helping you guys answer the question that you're constantly getting, which is, I want to put this in the name of my corporation. And at that point, there's a lack of knowledge that takes place in the realtor world as to whether or not that's a good idea, beyond saying speak to your lawyer, speak to your accountant. The goal here is not to give you the tools to give advice as to whether they should be doing this. The goal here is to inform you of the thought process that needs to take place surrounding that decision that will be dealt with in detail with the accountants and with the lawyers. And I would point out to you that when a deal comes into the lawyer's office, the lawyers then do verification as to the ownership and make sure that Jesse or Mark or whoever signed do have the authority to sign on behalf of the corporation. And there's ways we do that, but it doesn't make a difference. What you need to know is that we do that. We don't just allow it to take place. We have authorized signing resolutions, we examine minute books, we do all sorts of things on our end. But from your end as realtors, what you need to do is make reasonable inquiries, and the indoor management rule will protect you. And then you go ahead, get your signatures on these papers. And if, in fact, a corporation is the appropriate mechanism in the first place, which more often than not is not the case. So let me open it up to questions. What questions do you guys have for me? Come on, hit me up, guys. That's it. It was clear as mud. Everyone's good. Oh, here, I have a whole bunch of questions here. Well, only one really, but so it's better to use a corporation only if you'll leave money in there long term. When is it okay to pull out the money? So Alder, it's better to pull out the money as late as possible, because the moment you pull out the money, so you want to use the money within the corporation, but you want to use it as the corporation. You want to grow the money within the corporation. The longer you can grow the money in the corporation, the more advantageous a corporate setup is. The quicker you take out the money, the less advantageous it is. Any other questions for me, guys? Okay.
Mark, this may be totally off the record, so let me know. What if they keep the property for a while and then they got to do some renovations to it? How does that play into any benefits of the corporation?
Well, if they do renovations to the corporation, A, they can use that money that has been growing for the purpose of the renovations, and two, it affects the adjusted cost base of the capital gains on sale. Definitely, but it's the same thing as an individual in that regard.
Okay, I was referring to like the dividends and then having an expense and all that stuff, but no, so it doesn't, because that's a whole different aspect. One's personal, once you take out the dividend.
Correct. Yeah. And Tim has just said, can you remind me what the code for when the rollover to corporation? It's called a Section 85(1) rollover. It's actually Section 85 or 86, depending on what your accountant advises. It's usually an 85(1) rollover. Does capital gains also grow untaxed? Yes, it does. It's just a different tax rate. It's not untaxed. It's at a lower tax rate within a corporation. Yes, and capital gains is equally lower. Is it true that corporations can lend up to $200 for a personal, 200,000 K for a personal mortgage? Mary, I don't know the answer to that question. I'm not going to proffer a guess. You have to ask your accountant. I'm unfamiliar with that. It's very possible. It's just I don't have knowledge of that, so I'm not going to speak. I'm sorry. Any other questions, guys? Okay. By the way, I would think, Mary, if you want to know, I guess I said I'm not going to speak, but it turns out I am. I don't see why a corporation can't lend unlimited sums for a mortgage. I don't know why 200K would be a barrier. But again, this isn't my area. You'll have to ask someone. Ask your accountant. All right, guys, look, I'm very excited because next session, we're doing it on rural properties. The demand for rural properties and what an agent needs to know for rural properties is largely, well, it wasn't even my subject, and it was put in as an option for our poll, and it just overtook everything else that was there. Obviously, there's great demand for it. Matt Wilson is going to be teaching that session on the 4th. I strongly suggest you come. Matt Wilson is one of the smartest guys in our industry. He knows just about everything. And if you have an interest in rural property, or if you ever encounter it, Matt is the guy to learn from. So I'm thrilled we're going to be hosting that next on the 4th, which I guess is next week. Is it next week? 2 weeks? Whatever, it's the 4th. And look forward to seeing you all there. So thank you very much, guys.